This is CNNfN, the financial network.
My next guest says there are three issues the U.S. needs to focus on: the Federal Reserve's policy, the Bush administration's tax policy, and the 2004 presidential race. David Edwards, president of Heron Capital Management, is here to explain why. David, good morning and welcome.
Good morning, Kathleen.
I just want to start by asking you, before we get into some of my favorite topics, and I like looking at things in terms of the fundamentals, in terms of what's going on in corporate scandal land, Sam Waxel being sentenced today, Chris pointing out he pled, so he's going to get his sentence and maybe we put that behind us. But as that one seems to be drawing to a conclusion, Freddie Mac, the mortgage lending giant we talked about at the very top of the program, embroiled in a new scandal. This is a stock that a lot of people own. Many individuals and big institutions own the bonds, and they got clobbered yesterday. What do you think is the import broadly for investors of what's happening now at Freddie Mac?
We have a small position in Freddie Mac, just to get that out of the way. I think this reflects the new world of zero tolerance for accounting irregularities. From what I've seen so far, the issue is I brought in a new accounting firm last year. There was some repricing of derivatives. Actually increased profits, didn't decrease profits, but there was some discussion that the CFO, CEO weren't properly cooperative, and they've been fired. There's no allegations of fraud. The SEC is investigating. There may not be allegations of fraud. It's just a new zero tolerance policy. And
zero tolerance is good for investors?
I think so. The opportunity to clean out books, to make sure that everything's on the up and up, full disclosure in accounting statements and annual reports, I think it's all to the good.
Okay. So I want to touch on a couple of the things we just referenced a moment ago. You said the three things we should be looking at: Fed policy, tax policy, the presidential race. What is the importance of Fed policy right now? I know they're expected to cut rates. Is that going to make much difference to investors?
There is some discussion about cutting rates the week after next. I actually don't think there'll be a rate cut, and I say that because I look at money supply growth. It's still at a fairly rapid clip. You just had a cut half point last week in the European Central Bank that may address the dollar falling against the euro. I think the Fed would like to keep that last 0.75 in reserve in case we need it for something catastrophic like a terrorist attack, for example. So I think Fed policy stays as it goes. I think the other issue is that as we get away from the Iraq war, we get updates on economic reports, they're all coming in stronger.
Okay. In terms of where the market is now, bull market, bear market, or a market that has ended the bear market but really not begun a real bull?
Yeah, that's a question I'm getting from my clients right now. Is this a new bull market or is this a bear market rally? There's several models I look at. The Fed model is one that's often discussed. There's some doubt about it in terms of we're on unusually low interest rates right now. How good are earnings going forward? But even so, the last time you had a bubble this large, according to the Fed model, was the late 60s during the Nifty 50 era, followed by a big crash, 73, 74. We had a new bubble, the internet era, through the late 90s.
Let's take a look. I believe you have a chart we can look at so we can put a little picture with what some of this timeline you're talking about. And of course, when you talk about the Federal Reserve model, you're talking about a model that people have really extrapolated from some aspects of interest rates and stock prices that the Fed puts it in its big macroeconomic model of the economy. But talk to us about this chart, because I think, again, this is a story you want to tell your clients and our viewers.
Sure. The important thing to look at this chart is it covers 40 years of history. Theoretically, the S&P 500 should trade around the 0.1 line, the 0.0 line. At the far left of the chart, that's the Nifty 50 boom in the 60s. You see what a peak we had there. A few years later, quite a trough through the 73, 74, the OPEC crisis, the loss of the Vietnam War. Kind of sideways through the 80s. There's a sharp drop down for the 87 stock market crash. And then look over there on the far right.
That big move up.
Mount Everest spike, really unprecedented in this particular model, followed by a very sharp drop-off. So the question is, how good is that bottom there? Depends on interest rates. If they stay close to where they are now, that's good for this model if the earnings stay good. But what it's telling you is a green light for buying stocks.
Right, because every time we've gotten down that low, we've had a nice run up in the stock market, is what you're saying.
Absolutely.
And since so we could maybe not get quite to that last peak, but you're saying we could have another nice run up, even more gradual.
Yeah, the peak actually tells you that there's danger. That's when the market is essentially overvalued.
Okay.
Right now the model's saying about 30% undervalued.
Undervalued. Okay, so now let's talk before. So now we've got the model telling us the model says we should be moving higher in stocks. You said Fed policy will remain supportive, I believe. What about tax policy?
You know, lots of discussion about how this dividend cut's going to have a big positive impact on investors. I analyzed the stocks in my clients' portfolios and determined that based on the average dividend yield, their total return would increase by 0.35%.
So not that big of a deal.
So the dividend is not significant. For most of my investors, you know, they'll see a couple dollars extra in their paycheck, not significant.
The 2004 presidential race, though, one thing that stuck with me is someone making a comment in the last, I forget, 40 or 50 years, every year of a presidential election race year, the stock market has done very, very well, a lot because the sitting president tries to rev things up to make sure he, maybe someday she, gets reelected. Is that your point about the presidential race in the stock market?
That's what we call a calendar effect, and it's pretty well documented. The discussion a few weeks ago was that, okay, will Bush 43 play out like Bush 41, won the war, lost the economy, lost the election? And I think the answer is clearly no. Bush 41 had the misfortune of having his recession start the third year of his term, violating that calendar rule. Bush 43, his good luck to have the recession start in the last year of the Clinton administration. It's be well over by next year. Okay. And short of a disaster in foreign policy, he'll coast right into the...
What's your number one? If I did throw out a name, people say, okay, I believe him, it's going to go up. Where should they start looking? What's the stock to buy right now?
The stocks that I'm putting my clients into right now are all large cap growth stocks. And the reason why is those are the companies with cash in the bank, positive cash flow, the ability, as we saw with Oracle last week, to go out and buy smaller companies.
One name you want to give us?
You know, I'd say Fannie Mae after yesterday's sell-off would be a good opportunity.
Okay.
Buy in at a low.
All right. Thank you so much for joining us. A fascinating discussion. David Edwards, thanks so much.
Thank you.
This is CNNfN, the Financial Network.